when you have these overnight runs that were basically these big moves overnight before the session begins in New York. When you're trading equities, this also works with Forex too. So it's important trying not to chase price. This is what I mean by don't chase it. Overnight, what was the market doing? It was rallying. So when we open up at 8:30, do we go in here and start buying it just because it's gone up overnight? No, we don't chase it. You have to wait. Typically, whenever you see a big run up or a big run down, there's a consolidation that takes place shortly after. Now, not always. Sometimes it just keeps on ripping higher or lower, and you'll either miss a move, or if you get lucky, maybe you can participate in it. But this is what I typically look for. So if there's a lot of range movement overnight, what's overnight? 2 o'clock in the morning to 5 o'clock in the morning. If we get a big run like that, which is what we're seeing here, right away in my mind, I'm thinking, don't trade a lot. Don't expect a lot of in and out, perfect precision. Wait for a real significant price move. Otherwise, you're going to get chopped up. Now, what does that mean? Well, when we have it opening here at 8:30, look to the left. What do we have? We have this high here, and we have the low over here. We can use this one because they're relative equal, but I like this one. Why? Why do I like this one? What's below it? Fair value gap. So it's likely to trade down after it creates this sloppy opening. Look at all this movement in here. We start going lower first, so that's good. We create a pseudo Judas swing. But did it create a nice low and turn away from it? Look at all this back and forth. And it created these suspect lows in here. Relative equal lows. There's going to be sell side building up below that. Sell stops. When it starts to go higher, anyone that was long overnight, they're going to jam their stop loss right underneath that. When this occurs, that's the very scenario I'm looking for. Right away, in my mind, here's what I want you to understand. If there's a big move overnight for equities, this is not Forex. Okay, this part is not Forex. It's just for trading like NASDAQ, Dow, and E-mini S&P. If there's a big run overnight, avoid the New York session. Don't even mess with the New York session. Wait until the other side of lunch at 1 o'clock in the afternoon, New York time, and then anticipate the New York lunch lows taken out or the New York morning session lows, which is what we have here. Notice how we rallied up. We didn't take out the relative equal highs here that was formed ahead of 7 o'clock in the morning. Notice that? So if we can draw down below that low, it was formed initially in the New York session. We have a fair value gap over here with sell side, while we have yet to take out the buy side liquidity here and then get up to that fair value gap high. So this is the draw on liquidity, and we have a minor draw on liquidity here with buy side liquidity. Look what we have in terms of price action. The NASDAQ drops down, taking out the sell side, digging into that fair value gap. Look at the bodies of the candles. Isn't that neat? How it just respects that level back here. You don't chase the overnight run, and you wait for them to give you a low that everybody overnight will want to put their stop loss right beneath that after it starts to rally above it. It's even better when you don't have this high taken out yet. See how I took it up here? And it just went right down for them. That's engineering liquidity. It runs up, consolidates, creates a low, starts to rally, and everybody's thinking, I don't want to lose my profits. So the narrative with this day was the stops were trailed below these lows. The afternoon session, again, creates the low of the day, takes the sell side liquidity out into a fair value gap, and then rallies. Now in here, I'm going to teach you a little bit more about that. Watch. Notice we don't really have a fair value gap down here, but it gives us the basis for expecting the price to start to rally into the afternoon. Now, at 2 o'clock in the afternoon, we have the market trading down into an imbalance over here. Liquidity resting below these relative equal lows is taken out. So what are we looking at? We've seen a price run that we don't think needs to come back down here because the logic is the overnight stops have been ran out down here. There's no reason for the market to want to come back down there. But we have this low and these relative equal lows here post New York lunch. New York lunch is noon to 1 o'clock in the afternoon, New York local time. So the imbalance, we trade down into that. What's the likelihood of it coming all the way through the imbalance and then going after that low? Not likely. Not likely. Not after seeing this run here. They don't want to give these traders another chance to get back in. They got stopped out. So it's going to be a little bit more sneakier when they make these new setups to continue into a higher run. So they take out the sell side below these relative equal lows, take those stops out, and then it rallies and it drops back down. Now here, watch. We have a swing high right here. It breaks it. Does it trade above that? Yes. Was it energetic? Yes. Does it have a fair value gap? Yes. So now the market trades down into it here, creates a short-term low. You could be a buyer there. There's nothing wrong with that. The fair value gap is even better when you have the sell side liquidity resting below a short-term low. This is zoomed in on a 1-minute chart. Swing high, broken, fair value gap right there. And we have that short-term low here. I'm noted in here. So that's where you would be basically entering on with that idea. Trading below that is where the sell stops are. Trading below that. Now it goes below that. Does this invalidate the fair value gap? No, it does not. The idea is the fair value gaps. Well, look at the body of this candle here. Isn't that respecting that? Yes. learn to trust the setups and let the stops do their jobs. And if it gets stopped out, that's just one trade you got wrong. It's not your career. Look for the next one. It rallies here, takes off, and does not take out that. The buy side liquidity resting above here did not get taken here yet. And then we had this imbalance, and it trades down into it, and then hits what? The order block. That's a buy. And you can, if you miss this one, you can pick up this one based on the logic I teach on the YouTube channel. This whole pattern here is exactly right out of my high probability short-term trading or scalping series. I can't remember exactly what the title was, but this pattern here is right in that. And then it runs for that liquidity there. So there's two setups there.